Right now, in this exact moment, something is building beneath the surface of the gold and silver markets that most people are not paying attention to. Gold has been locked in a 6-week consolidation range. Silver is squeezing tighter and tighter between two trend lines, and the clock is running. Because here's what the charts are showing us right now, in early August 2026. This compression, this coiling, does not last forever, and when it breaks, it does not announce itself politely. It moves fast, it moves hard, and it catches the unprepared completely off guard. The last time gold sat in a range this tight heading into August, what came next was not small. And the setup right now, from the macro data to the technical structure to what central banks are quietly doing while the headlines are focused elsewhere, every single piece is pointing in the same direction. Gold hit an all-time high of $5,597 on January 28, 2026. Silver touched $116 in the same window. Both have since corrected dramatically. Right now, gold sits near $4,050, and silver is trading around $58 to $59 per ounce. And this is exactly the point in the cycle that separates the serious investor from the crowd, because the crowd sold. The serious money, and we're going to show you exactly who, is buying. Stay with us through every part of this video, because by the end, you will understand not just what is happening in precious metals right now, but why the setup forming in August 2026 may be the most important one of this entire cycle. Welcome back to the channel. I'm glad you're here. Before we get into the data, drop a comment right now. One word, just one. Tell me, are you watching this because you're holding gold and silver, or because you're watching and waiting for the right moment to get in? Drop it below. I read every single reply, and your answer right now is going to matter by the end of this video. If this kind of serious, data-driven breakdown is what you came here for, hit subscribe, hit the like button. This channel is built for people who want the real picture, not the noise. Let's get into it. Part 1. The compression nobody is talking about. Let's start with what's actually happening in the market right now, because the mainstream financial commentary has completely missed the significance of this moment. Gold entered August after 6 consecutive weeks of the tightest consolidation range of the entire year. Price has been straddling a zone between roughly $4,070 and $4,110, the 61.8% retracement of the March decline, pressed up against what analysts at Forex.com have identified as a critical inflection point. 6 weeks locked in a box. Neither buyers nor sellers have been able to force a decisive break. That pattern has a name: coiled energy. And in technical analysis, the longer price compresses inside a tight range, the more violent the eventual breakout tends to be. You do not get 6 weeks of this kind of compression and then get a calm, boring resolution. That is not how markets work. The key level every serious gold analyst is watching right now is $4,312 to $4,320. That is the 52-week moving average. That is also the 2026 yearly open. A confirmed weekly close above that level, according to the technical structure, would signal that a medium-term bottom is in place and shift the momentum squarely back to the buyers. On the downside, the critical support that must hold is $3,960 to $3,930. A break below that zone reactivates the bearish scenario and opens the door for another leg lower. Right now, gold is sitting between those two walls, and the first major catalyst to hit this market, whether it's an employment report, a Federal Reserve signal, or a geopolitical development, is going to decide which wall breaks first. Now let's look at silver, because silver is actually doing something more interesting right now than gold. Silver at $58 to $59 is forming a tightening triangle on the short-term chart. Rising support, descending resistance, price being forced into a narrowing point. This is a textbook technical compression setup, and when triangles resolve, they resolve fast. Traders are currently watching the $60 level as the immediate breakout target. Beyond that, the next meaningful ceiling sits in the $66 to $68 zone. And if the broader macro environment turns constructive, the path toward $80 comes back into focus. But here's the nuance that most commentary is missing. The technical picture in silver and gold is not the story. The technical picture is the surface. The real story is what is happening underneath, in the fundamentals, in the supply chain, in the behavior of the largest institutional buyers on earth. And that story is where this gets genuinely extraordinary. If you came here for a surface-level price check, you've already got more than you expected, but we're just getting started. What's coming next is the part that institutional investors already know and are positioning for quietly, while the retail crowd is still debating whether precious metals are even worth owning right now. Part 2. The supply crisis that can't be fixed. Let's talk about silver's structural story. Because what the Silver Institute published in their World Silver Survey 2026 is one of the most important data sets in the entire precious metals market right now, and almost no one in the mainstream financial press is giving it the attention it deserves. Here are the facts, sourced directly from the Silver Institute. 2026 marks the 6th consecutive year of structural supply deficit in silver. Not a temporary shortage, not a blip. 6 years running where total global demand has exceeded total global supply. The deficit in 2026 is projected at approximately 46.3 million ounces, wider than the 40.3 million ounce shortfall recorded in 2025. Now here's the part that makes this structural rather than cyclical. Approximately 70% of global silver supply is a byproduct of mining other metals: copper, zinc, lead, gold. This means silver production does not respond quickly to rising silver prices. You cannot simply decide to mine more silver because the price has gone up. You need to find and build dedicated silver mines, which take 7 to 15 years from discovery to first production under ideal conditions. COMEX registered silver inventories, the metal actually available for futures delivery, have fallen roughly 75% since 2020. From approximately 346 million ounces down to around 88 million ounces as of earlier this year. Meanwhile, on the demand side, several forces are pulling simultaneously in the same direction. Data centers, artificial intelligence infrastructure, electric vehicles, solar panels. Every single one of these technologies depends on silver. You cannot build an AI data center without silver. You cannot build a solar panel without silver. You cannot build an EV without silver, and every one of these sectors is growing. The Silver Institute also confirms that coin and bar demand is forecast to rise 18% in 2026, driven by a recovery in U.S. retail buying. More buyers seeking physical silver at the same time physical supply is tightening. That is a simple supply and demand equation, and it has one natural conclusion. The supply that was never developed during years of lower prices cannot be conjured into existence overnight. That is not a theory. That is arithmetic. Part 3. What the institutional money is doing. Now let's look at the behavior of the large, serious buyers, because this is where the picture becomes genuinely compelling. Central banks bought a record 1,237 tons of gold in 2025, the third consecutive year above 1,000 tons. In just Q1 of 2026, central banks added 244 net tons, according to the World Gold Council. Poland's National Bank led the way with 14 tons. The People's Bank of China added another 8 tons. This is not reactive buying. This is strategic positioning. These are institutions managing reserves measured in hundreds of billions of dollars, and they are systematically increasing their allocation to physical gold. That does not happen by accident. That does not happen without an underlying conviction that something in the global monetary system requires a hedge. Now, on the institutional forecast side, here's where things get interesting for investors paying attention. Goldman Sachs has set its year-end 2026 gold target at $4,900 per ounce. JP Morgan expects gold to reach $4,500 in Q4 of 2026. HSBC currently forecasts $4,560 by year-end. The most conservative major bank forecast from StoneX sits at $4,000, which is essentially where gold is trading right now. What that tells you is that even the most bearish major institutional forecast sees no significant further downside from current levels, and the median institutional forecast sits roughly 10 to 20% above current prices. The disconnect between where gold is today and where every major bank expects it to be by year-end is not a contradiction. It is an opportunity, one that closes the moment everyone else sees it. Goldman Sachs has also quantified something important. Every 50 basis points of Federal Reserve rate cuts adds approximately $120 per ounce of price support for gold. Goldman no longer expects any cuts in 2026, pushing the first projected cut to mid-2027. That means that rate support is deferred, not removed. The moment the Fed pivots, that $120 per 50 basis point calculation kicks back in immediately. Meanwhile, core CPI continues to run above the Fed's 2% target. Real interest rates, the difference between prevailing nominal rates and actual inflation, remain negative. And negative real interest rates are, historically, the most consistently bullish environment for precious metals ever documented. Here's a question worth sitting with for a moment. If every major bank is forecasting gold meaningfully higher by year-end, and silver is entering its sixth consecutive year of structural deficit, what exactly are investors waiting for? We'll come back to that. Because first, there's a macro picture that ties all of this together in a way that changes how you think about what safe even means right now. Part 4. The macro picture. What the Fed can't say out loud. The Federal Reserve is in a position it has never been comfortable admitting it is in. Rates are sitting at 4.25% to 4.50%. Inflation remains stubbornly above target. The labor market is showing signs of cooling, and the national debt, now requiring enormous and growing interest payments just to service, is limiting every option on the table. One respected analyst described the Fed's current position plainly: trapped. April CPI came in hot. Markets have fully priced out rate cuts for 2026. Some traders are even pricing in a rate hike before year-end, with roughly 65% probability of a September hike currently being factored in by futures markets. Under normal conditions, that would be devastating for gold. Higher rates raise the opportunity cost of holding a non-yielding asset. But gold has not collapsed, and that tells you something important. It tells you that the market no longer fully believes the traditional relationship between rates and gold holds in the current environment. Because when an analyst compares the current environment to the stagflation of the 1970s and 1980s, a period when rates were extremely high and gold performed extraordinarily well, that is not a nostalgic comparison. That is a structural read on what happens when inflation and economic stagnation arrive simultaneously. The 30-year Treasury yield has climbed above 5.2% for the first time since June 2007. Rising yields are creating headwinds for gold right now. They raise the opportunity cost of holding an asset that pays no interest. But the historical record is clear. When yields rise because of inflation rather than because of genuine economic growth, gold and silver have eventually moved higher anyway, sometimes with a delay, but always with force. The dollar index, the DXY, is another key variable. Recent analysis shows the dollar facing a notable rejection near resistance, with the structure beginning to point lower. A 2 to 3% decline in the DXY tends to carry outsized implications for gold and silver pricing because both metals are priced in dollars globally. A weaker dollar makes gold and silver cheaper for foreign buyers, accelerating demand. The macro environment right now is not simple. It is not a clean, one-directional story. It is a complex, tension-filled environment where multiple forces are pulling simultaneously, some against precious metals in the short term, and powerful structural forces in favor over the medium and longer term. The investors who understand that distinction, who can separate the short-term headwind from the medium-term signal, are the ones who position accordingly, rather than reacting emotionally to every data point. Part 5. The gold-silver ratio, the trade hiding in plain sight. Let's talk about the ratio, because for the investor who is already in precious metals, this may be the most important single data point in this entire video. The gold-to-silver ratio, the number of ounces of silver required to purchase 1 ounce of gold, currently sits at approximately 68 to 70 to 1. The historical average of this ratio is 55 to 60 to 1, reflecting the natural geological abundance of silver relative to gold in the Earth's crust. When the ratio is above its historical average, silver is statistically cheap relative to gold. When it normalizes, as it has done repeatedly throughout recorded financial history, silver's move is proportionally larger. For perspective, in April 2025, this ratio exceeded 100 to 1. It then compressed sharply as silver rallied 147%, while gold moved significantly less on a percentage basis. Investors who understood the ratio in early 2025 captured extraordinary gains. The ratio is now back in the 68 to 70 range, still elevated relative to historical norms. If the ratio were to normalize back toward its 55 to 60 historical average, at the same time gold is recovering toward institutional year-end targets, the mathematics of silver's potential move becomes significant. This is not a promise about future prices. This is a documented historical pattern with a very long track record. This is why serious analysts describe silver as having leveraged upside relative to gold. The same macro forces that push gold higher tend to push silver higher faster and further, particularly when the ratio is entering a compression phase from an elevated starting point. Part 6. The trigger. What to watch in August. So we have established what the structural picture looks like. Now let's talk about what actually matters in real time. What are the specific triggers that could move these markets in August and the months immediately ahead? Number 1. The Federal Reserve. The next FOMC decision and any signal around rate direction is the single most watched macro variable in precious metals right now. A rate hike would create short-term pressure. A hold with language suggesting the hiking cycle is complete could remove significant headwind. Any signal of eventual cuts, even if distant, would be immediately supportive. Watch FOMC language, not just the rate decision. Number 2. Employment and CPI data. The U.S. jobs reports and inflation readings are what the Fed is watching, and therefore what gold and silver are watching. Soft employment data eases rate hike expectations. A softer CPI reading gives the Fed room to signal eventual easing. Either of those developments is a near-term catalyst for precious metals. Number 3. The $4,312 to $4,320 level in gold. This is the technical line in the sand. A confirmed weekly close above that range, above the 52-week moving average and the yearly open, shifts the entire technical picture. Until that break happens, the medium-term structure in gold remains uncertain. When it happens, it removes that uncertainty. Number 4. The $60 level in silver. Silver is pressing against this level right now. A decisive break above $60 with volume behind it opens the path toward $66, and then toward the next major level in the $75 to $80 zone. Watch the $60 break on silver as a near-term signal. Number 5. Physical inventory levels. The COMEX registered silver inventory and LBMA vault stock reports are not mainstream news, but they are among the most honest signals available in precious metals markets. 6 consecutive years of deficits have been slowly drawing down above-ground stockpiles. Any spike in silver lease rates or delivery stress on COMEX would be a signal that the physical market is reaching a stress point, and that is the kind of development that can accelerate price moves significantly and rapidly. Let me bring this together with a thought that is both honest and direct. The story of precious metals in 2026 is not a simple story. It is not gold goes up, buy gold. It is a layered, complex convergence of macro forces, some pushing in opposite directions, that is creating a tension in these markets that cannot hold indefinitely. What we know with real confidence right now, based on verified current data, gold is 25% below its January all-time high. Every major institutional forecast, Goldman Sachs, JP Morgan, HSBC, sits meaningfully above current prices for year-end. Central banks are buying at record pace. Inflation remains above target. Real interest rates are negative. Silver is in its 6th consecutive structural deficit. COMEX inventories have fallen 75% since 2020. Industrial demand from AI, EVs, and solar continues to grow. The gold-silver ratio remains elevated versus historical norms. Technically, both metals are compressing in tight ranges that do not stay compressed forever. The investor who waits for certainty, for the moment when everyone agrees and the opportunity is obvious, typically discovers that by the time clarity arrives, so has the price move. The investors who were in silver at the beginning of 2025, when the gold-silver ratio exceeded 100 to 1, did not need certainty. They needed data, patience, and the ability to hold conviction through uncomfortable periods. We are in another period that feels uncomfortable. That is not a warning. For the serious, long-term investor with a clear framework, uncomfortable periods in fundamentally sound assets are not threats. They are the setup. Watch the triggers. Understand the structure. Know your time horizon, and stay informed. That is exactly why this community exists, and we will be here watching every development with you. Thank you for watching. Subscribe if you're not already. Drop your thoughts in the comments. I want to hear where you are in your precious metals journey right now, and we'll see you in the next one.